Welcome to Magnet Minutes. This is Jordan Kimmel with an update for April 13th, 2022. And again, it's a privilege rather than talk myself to bring on a special guest. Today we have Jeff Hirsch, the editor of the Stock Traders Almanac, one of my actual favorite annual books, also the editor of the Almanac Investor Newsletter, and probably one of the great stock market websites as well. Jeff, thanks so much for joining us.
Always a pleasure, Jordan. How's everything?
Everything's going great, Jeff. You know, it's a fantastic time overall, but you know what? The news cycle, I've been begging people to stay off of page one. It's a very tough time, as you know, in the world. But Jeff, I've been asking you to come on Magnet Minutes for a while, but you know, it's interesting time right now. There's so much kind of in the news around the Almanac's dates right now, and so many things going on. I'm really glad you're joining us at this time.
Yeah, it's a good time for us. You know, we're coming to the end of the best 6 months here in April. We've got the midterm election year, pattern, that heightened volatility we've been talking about for months in our newsletter, and you and I have discussed it not too long ago. And you've got that weak spot of the 4-year cycle, which is the Q2, Q3 of midterm years, the second and third quarters, runs along with the worst 6 months, the sell in May period, though we don't go away in May, we reposition. And it's not unheard of to have some geopolitical stresses and issues in, the first 2 years of a president's term, and the midterm year. And it's no secret around the world that, this is the time to take advantage of a, new administration. And it's just kind of a little too typical, a little too coincidental. I mean, one of the things that we looked at recently, I'm not sure if you saw it, was the down first quarters in the midterm year.
I have seen you write about that.
Yeah, I put a little table together of the previous times, and the thing that jumped out at me, aside from the numbers and the performances, the Q2, Q3 kind of not so great, and then things start to turn around in Q4, very typical of midterm years. But the events that were going on in those years were so similar to what we're seeing here, with words inflation and recession and war and bear market, and it's just a little disconcerting. You and I are both not screaming bulls right now. You might be a little bit more bearish than I am, but still, it's a lot of headline risk. There's a lot of fundamental and technical risk that we're seeing there. So I'm with you on the confluence of the time of year right here.
Right. Well, let me get into something again, Jeff, because you play a special role in the market itself. And we just before we went live, we talked about one of the favorite Mark Twain quotes you like to use. And the point is, this is what the Almanac is all about: repeating, maybe not exactly repeating, maybe rhyming, but patterns that do exist. And Jeff, I was with big Wall Street firms for many years where they always said, today is a great time to invest. Sometimes it's not a great time to invest. Sometimes it's good for powder. So you
see the little bears in the Almanac.
Yeah, and there's a lot of things stacked up against the market right now, and maybe you want to address a couple of them, whether it's the midterm cycle of the presidential election, but clearly not every day. Even if you got a great golf game, I know you like to play, if it's thunder and lightning, I like to say, no matter how good your golf game is, you belong in the clubhouse.
It was cold last Sunday, but we played anyway with 3 layers. But yeah, I mean, lightning, thunder, you belong in the clubhouse. And I think we're getting into that clubhouse time of year here in time of the 4-year cycle. We've got the 2 main cycles we keep talking about. The worst months of the year coming up here, May through October, and the worst, period, the weak spot of the 4-year cycle. On top of that, we've got a lot of fundamental and technical things stacked against us. Inflation, energy prices, the technical issues that I'm looking at. We've been looking at the NDX a lot as sort of a leading chart to watch. And
NDX, share NDX for people what it is.
That's the NASDAQ 100. It's what the QQQ is based on. Sorry, the ETF, and that's the 100 biggest, most important tech stocks in the world. Seems to be the thing that leads the world economy these days. There's still some other leading companies in the Dow and other places that aren't in the NASDAQ 100 or the Qs. But there's some technical issues there that we're struggling with. There was a little potential W123 swing bottom, with the February, and I'm looking at the intraday chart, the February 24th low. I don't know if you're looking at that, the intraday low, the day that Russia invaded Ukraine was actually a positive day, but intraday in the morning, and I think it was even a little worse overnight, that low has pretty much held, even more so on the S&P and the Dow. And we did a little retest of that kind of on a closing basis. March 8th, I think, was the day, and there's a little W in there. And the middle point of the W becomes that sort of support line. We've now sort of come through that. Concerning for me. We failed to clear the 200 day. There's some technical analysis struggles and also internals.
Well, what I want to do here, we'll get to the internals in a minute, but I want to bring up an important point you're just kind of glossing over, which is that the Stock Trader Almanac in your newsletter is built on decades and decades of research, but let's get a little sunlight. You have dynamic researchers working with you now, and the model gets updated a little bit. So not only is it pure seasonal, but you're bringing in some technical work, updating, if you will. And so give a little sunshine to your staff and some of the research that's been added to what the Almanac's been doing for decades already.
Not just the current team, but my late father also taught us all about fundamentals and technical analysis and monetary policy and sentiment. So, we're known for seasonal patterns and historical patterns and cycles, but you can't, nothing works 100% of the time. As I joke, I don't work 100% of the time. We talk, I play golf sometimes and other things.
Okay.
Sometimes we have dinner with the family, but it's not pure seasonals. And you hear from people who are technicians, they're pure technicians, all about price. Yeah, that's great. I like technicals as well, but we look at 5 basic disciplines: our foundation, our roots, and cycles, seasonalities, patterns, and trends, and then fundamentals and individual stock fundamentals, growth and revenues, one of your, fortes as well, and then GDP and, economic fundamentals, as well as price movement, technical analysis, which to me runs with market internals, advanced declines, and new highs and new lows. I've been told also by some of my technician friends that seasonality is basically technical analysis. You're talking about the movement of prices over time, which, okay, I'll give them that. I'm happy to go in there. And then the sentiment, the psychology. People talk about the VIX a lot. Didn't quite get as extremely bearish as we'd like to see. Some of the other things did, investors' intelligence, bulls and bears, got a little bit more bearish than some other things. Those are like the newsletter writers and analysts and stuff.
So Jeff, let me kind of bring us, so let me bring us to another spot here. And you mentioned the technicals or the internals, and I'll just bring up one piece for myself, and then I'll let you carry it, which is that, the indexes have stayed up here. The big index is really down, not even 10% right now, but the internals of the market are actually dreadful. And the advanced decline line on NASDAQ has been hitting new lows for months. My opinion is that we're only halfway through a bear market. There's been tremendous damage underneath, but it brings me to the next piece of whether or not it's a great idea to fight the Fed. There's some quotes in your book on that, and the Fed is saying completely transparency, they're going to be something to reckon with.
They are. Your point about the bear market is great, but I think what you're saying, the underlying bear has been much grislier.
It's been rough.
And NASDAQ and the NASDAQ 100 hit that 20% level. I don't judge bear markets based upon that, but a lot of people do. I'm a bigger proponent of the Ned Davis definitions, which we didn't achieve. I think we've had a good chunk of the bear market already. Official bear market on S&P and Dow, no. But the bulk of stocks, as you're saying, yeah. The Fed is a force to be reckoned with. They're a lot more transparent now than they used to be. So I'm not so sure it has as much impact. I don't want to get into a this time is different situation
Okay,
because it's always different.
right.
But there's also there's always repetition. There's always, the history repeating as we like to discuss. But this time around, we're coming from such a historically low number. I don't remember any time in history we were at zero for so long.
Because we weren't.
Right. So even if we go up 9, hikes or whatever it might be, up to 3%, we're still historically low. I suspect, we're probably going to get a little bit more than, 4 quarter-point hikes like we were thinking before everything started hitting the fan. I even saw Jeremy Siegel in a clip on CNBC yesterday saying that he thinks they're going to do a 0.5 point in May, which I think the market wants right now. So yeah, you don't fight the Fed, but you got a Fed that's got to get inflation under control, and going from 0 to 0.75, while
right, that's
big
still
increase.
play. That's historically low. You're 100% right. And Jeff, to your point, that maybe the Nasdaq is down 20% or hit 20%, but Jeff, there's a lot of individual companies that were super hyped that has no earnings, that have no prospects for earnings, that are down 60, 70, 80%. And even great companies, and I'll just name one, like you use DocuSign for business, and you look at PayPal, these things are down 50% and 70%, and there's some tremendous damage. I'm under the opinion that people are still way too complacent. There's a lot of opportunity, I believe, there will be to short this market, and I believe we're only halfway through the pain. That's only my opinion.
No, and everyone's got one, like me and you, but you have a knack for shorting, and I think you'll do well with some of that. The overall market, I think is going to track that midterm cycle with the lower end of it. My chart that will show everybody when we put it in there, but I think we test the lows several times. We might breach them a little bit, but I don't see much upside over the next 3 to 6 months. It depends upon what happens. Headline related and Ukraine war related. Inflation looking like a lot of people are talking about it peaking. One of the things that Chris and I have been talking about is oil and the correlation with inflation, PPI and CPI. That it's historically, from what we've seen, pretty much inflation peaks when oil peaks. But we've got the situation over in China with the lockdowns and their zero COVID policy, which is really sort of, I've read some things recently. It's causing some issues. It's really bottlenecking up the supply chain situation, and that even if oil comes down, which it has already, and inflation starts to come down, it's going to be stickier and not transitory because of the supply chain issue, I think, really impacted by the COVID policy over there in China.
Right. And so Jeff, we're going to have a couple more things I want to touch on, then we're going to wrap it up. But, one of the things, just to let a little cat out of the bag, is that we believe in patterns. We believe in current research. What you have to look at, like we talked about, is what's going on now. Yeah. What's the advanced decline line look like now? I happen to agree with you that we're following this midterm pattern where if everything goes right, there's going to be an exceptional buying opportunity. And I want to just bring out something that we had Jimmy Rogers on recently, and Jeff, he said to me, the reason this time it's different is because this time the world is actually going to end. And then we laughed and we said, let's make sure when it does end that we step up and we buy. And there'll be all kinds of fear at that time. There'll be all kinds of incredible paranoia, which brings in the lows. But it's funny, he said, Jordan, this time the world does end. And And so it's good that we got that laugh out of you. One more thing before we wrap it up. I know that one of the things you do, you have your newsletter that keeps people informed. Why don't you also spend a minute, share your website information, because I know it's pretty dynamic. There's always something to learn. And Jeff, I'll just share, as I do all the time, I look forward to the Almanac every single year. I think it's one of the most insightful, resourceful books. And my God, I laugh and I smile how many times the Stock Traders Almanac is quoted on television and in print. And congratulations on the brand, and taking it to new heights. And share the website information, please.
Sure. Appreciate that, Jordan. StockTradersAlmanac.com. Pretty simple. Twitter's Almanac Trader. And what we do with the newsletter is basically put the Almanac to use, creating portfolios, combining fundamentals, technicals, sentiment, and our seasonal patterns, historical patterns to create stock and ETF portfolios. We have a sector rotation portfolio, different stock baskets throughout the year. And of course, our tactical seasonal switching strategy based upon the best and worst 6 months. A lot of people talk about sell in May and go away. They got to remember to buy in October and get themselves sober, as I like to joke.
Okay.
But in reality, we don't go away in May. If you look at the pattern, it's not selling in May and it goes down. It stops going up and bounces around, is more prone to volatility during these periods. There's a lot of reasons for that. And one of the things I want to leave you with, if we want to end it here, is, sometimes seasonality, when it doesn't work, becomes an indicator. And when the best 6 months is not up, it's not a great sign for the worst 6 months. Gains beget gains, losses beget losses.
Interesting.
And we've seen this before, like in the years of 73 and 74 and, or 72, 73, 73, 74 and 07, 08 and 08, 09, when the best 6 months didn't work. 09, it turned around, but usually the first time we have a bad best 6 months, it doesn't bode well for the next six.
Interesting to hear. And, we'll leave it at that. One other thing I'll say, Jeff, is that sometimes it's summer and you think it's warm out. Sometimes it's winter, you think it's cold out, but it's good to check, step outside and dress accordingly. Be what we say in the now, and not rely on too much of historical. But Jeff, look, it's great to have you on. I love our relationship. And we'll have you on periodically. And it's Jordan Kimmel and Magnet Minutes. Jeff, so great to have you on. Thanks again.
Always a pleasure, Jordan. Thanks very much, Bob.
Okay.